Now, what do we do with this trial balance? We can use this trial balance to create essentially our set of financial statements. We will create them in a particular order. We're going to do our income statement first. We need some of the information from our income statement to do the statement of stockholders' equity, and then we need information from the statement of stockholders' equity to do our balance sheet. So we're going to record these in a particular order. We will start with the income statement. We'll put a heading on it, ABC Company. Income statement for the year ended, whatever date the year has just ended, that's the year or the period of time for which this income statement covers. Again, remember that income statement covers a period of time. The transactions of of selling the goods and paying of the wages didn't all happen at one single instant. They happened over a period of time at different days, maybe even different months, possibly of the year. So an income statement captures all the activity that happened during the particular period of time. In this case, I'll assume a year. An income statement starts with our revenue, $25,000. Subtracts our cost of goods sold of $8,000. To calculate a gross profit, $17,000. You'll notice we didn't have a gross profit account. The gross profit is simply a subtotal that shows up on the income statement. It's not a separate account. We've got an account for revenue, an account for cost of goods sold, but gross profit is simply a subtotal. Any of your subtotal accounts are not going to show up, any of your subtotal lines on your financial statements won't show up on your trial balance or in any of your accounting records. Going to subtract from this our wages expense. And we will get our net income of $10,000. So we had revenue of $25,000, total expenses of $15,000, $8,000 and $7,000, and for net income of $10,000. So during this period of time, this company earned capital of $10,000. They provided value to customers. That value was worth $25,000 to those customers. It took $15,000 worth of resources, the inventory that was sold, and the value of the people's time that worked there for $7,000. So together, those two resources, the goods that were sold and the people's time, totaled $15,000. So the total value that the company increased was $10,000 of increase in earned capital. Now we need to know this net income because we're going to transfer this to our statement of stockholders' equity. Recall that because of the purpose of a business, the importance of equity ownership, stockholders' equity gets its own statement. Again, it's really the statement of changes in stockholders' equity over a period of time. So we will add a heading that says for the year ended, and it would be for the same period of time for our income statement. Now we have, as we mentioned in our account analysis, two different kinds of equity accounts. We have contributed capital and earned capital, and both of these are going to be reported in our statement of stockholders' equity. The particular type of contributed capital we have is common stock. And the earned capital retained in the business is, of course, called retained earnings. And for each of these accounts, we're going to record the changes during the year. So we're going to start with the beginning balance, which was 0 for both of these. The business had just started during the year. There was a change to the common stock account because of the issuance of $50,000 of common stock, and there was a change to the retained earnings account because of the earning of $10,000 of net income. Again, relatively simple, but it's a complete summary of the transactions. And again, notice we're losing a little bit of information. We know that we have $10,000 of net income, but from looking at this income statement, we don't know how much of revenue and how much expenses there were. We don't know if there was $15,000 of revenue and $5,000 of expenses, or $100,000 of revenue and $90,000 of expenses, or the $25,000 of revenue and $15,000 of expenses there really were. The purpose of this statement is not to explain the amount of net income in detail, but to explain how the amount of net income affects stockholders' equity. So we have total stockholders' equity at the end of the year of $60,000, which is the sum of the 50 and the 10. We now have information that we need to go into our balance sheet. And notice that a balance sheet is as of a particular point in time. The balance sheet does not summarize all the transactions that happened during a point in time, but as of a point in time, as of essentially December 31st, or whatever the last day of the year is, what was true about the business? What did it own? What did it owe to creditors? And what claims did its owners have at a single point in time? Our balance sheet essentially reports our fundamental accounting equation, assets equal liability plus equity. We're going to pull these amounts off of our trial balance. Cash of $37,000, accounts receivable of $25,000, inventory of $8,000, and a building of $30,000 for total assets of $100,000. Now notice our total debits on our trial balance was $115,000, but our total assets are only $100,000. Why is that? Well, two of the debit accounts were expense accounts, not asset accounts. The cost of goods sold of $8,000 and the wages of $7,000 were debit accounts that were not assets or not reported on our balance sheet as assets. The other side liabilities and equity. We have our note payable of $40,000. In our equity, we have our common stock of $50,000, and we have retained earnings of $10,000. We can subtotal our equity for a total equity of $60,000. And total liabilities and equity, $40,000 of liabilities plus $60,000 of equity is $100,000. Our balance sheet balances. That is good to know. So you see what we have done is gone through a complete cycle of analyzing transactions, those original 6 transactions, analyzing them, recording them in journal form in our general journal, summarizing those journals in our general ledger, summarizing the general ledger in the trial balance, and then using the trial balance to create a series of financial statements, and ultimately reporting all those transactions in proper financial statement form. So that is a summary of a relatively simple business and its accounting transactions.